I want to get your expectations for the jobs report. How do you think the market reacts? And what metrics in this report do you think the Fed is paying attention to?
Well, look, it would have to deviate from expectations. We think that this is going to be a period in which gradually we're going to see weaker job gains. The spring period, when we start a big ramp up in hiring and then we adjust it away. This is going to be one of those reports that might look a little bit different from what we saw in the winter. It could be closer to 200,000 for the gain. And that compares to 276,000 in the first quarter. We've been in a very slow moderation of employment since we bounced back from the pandemic in 2021. And monetary policy, maybe it's not tight enough for some people, not fast enough to get inflation down really rapidly, but it's a lot tighter while the employment gains have been moderating. So I think if this continues, if this came down to below 200,000 pace at mid-year, the Federal Reserve, coupled with ideally better inflation data than the bounce back in the first quarter, we think that it's not out of bounds. Get some easing this year.
So, Steven, I want to go back to your idea that the job gains are moderating. We're just showing the bar chart with the month-over-month job gains. It doesn't look like they're moderating at all. But we also had an earlier guest on today saying that number actually doesn't matter. We had a guest on forecasting that we're going to see a hotter than expected number when it comes to jobs, that it's really wages and wage growth that matters. Do you share that opinion as well?
So look, the wage gains of the first quarter reported in the employment cost index, where you can actually compare the same industries, not a different composition every month. Again, that was on the strong side. It still has been coming down, though. And if the labor market were just too impossibly tight, right? If the labor market was overheating, wages would be accelerating, not moderating. So the pace is strong. What you see on the shorter term chart, that their gains in employment growth is strong. All of this is fine. It's a self-reinforcing expansion cycle. But monetary policy is tighter. We've had about 3.7 million unfilled job openings already disappear in the past 2 years. And if you look at this in a little bit longer term time frame, I entirely agree with the Fed's view that it's coming into better balance in the labor market.
All right, so I'm going to put you on the spot here, Steven. What's your outlook for the rest of the year? Where does core PCE get to? Does it get to a level at least close enough to 2% for the Fed to actually cut this year? Because Jay Powell, he seemed to be pretty clear that it's really got to get to 2%. Do you believe him? Do you believe the FOMC?
Let's remember that the Fed's inflation target is a long-term inflation target. They would measure these things, whether they're really on target or not, over a decade. And when you think about where we are, the March PCE reading for core was the lowest of this cycle, 2.8%. Could we be 2.3 by the end of the year if we moderate employment, if import prices continue to be low on a strong U.S. dollar? If housing services, again, they'll probably bounce back in the coming year, but if that contributes some to slowing, yeah, you could see the PCE deflator, again, low enough for the Fed to take their foot off the brake a bit.